Welcome to the Zacks Roundtable Review, a discussion of current events affecting investors as well as other topics of financial interest, featuring the analysts and editors of Zacks.com. Well, the stock market's made a new bottom. Now what? For the answer to that question, we turn to our panelists, who today are Steve Reitmeister, our editor-at-large, our senior market analyst, Charles Rotblatt, and that top stock screener for Zacks.com, Kevin Matris. You know, it's an easy question to ask, maybe not so easy a question to get the answer to, but that's what's on everybody's mind this morning, I'm sure. Now what?
Yeah, the market is making new bottoms, and what does that mean for the near term and what's going to happen from here? For me, I don't believe we've actually made the bottom yet. And I'm not going to steal any of Charles' thunder because I know he's got some statistics that I also believe in for how you could perhaps calculate what should be the bottom for the market. So I don't think we've reached it yet. But that doesn't mean that we necessarily go straight from point A to point B. What I'm saying is, yes, the economic environment's terrible, which makes for a terrible market environment. But we're pressing up against some pretty strong support right here. We are also see from the technicals that it's a very oversold position. And the last time we were down in this neck of the woods, we had a 20% rally. Now, I'm not expecting a 20% rally in the near term, but to see a 5 to 10% bump up, a dead cat's bounce, as we talked about earlier, right, from here would not be unusual. So I still believe the bottom has not been found, but to see a little bounce in this market, given how rough it's been lately, that would not be unusual.
And now for those figures that you've worked so hard at.
Well, I'm going to get to the figures in a little bit, but first one of the things I want to kind of really touch on what Steve said, and I talked about this in 2 blog posts last week. We are oversold on a short-term basis. If you look at stochastics, and I've talked about that before on our videos, if you look at stochastics, we are oversold on a short term, which means we should get a short-term bounce. And it's very important to understand that when you're seeing the markets go either up or down, they never go in a straight line. Mm-hmm. However, we are going to continue to go down. There's been a lot of discussions about making a correlation between what we're seeing right now and the Great Depression. One of the things that's interesting, I had a conversation with a reporter on Friday about this. If you look at what preceded the Great Depression, heavy use of margin, I believe back then, people could just put down 5% on margin and buy as many stocks as they want on top of it. So very huge leverage. It's not unlike what we're seeing now with the housing, where we had a lot of people really either put no money down, or in a lot of cases just 5%. Right. And again, heavily leveraged, prices contracted, people got caught. We had a huge, drop in the market. That's really what we're seeing now. Financial crisis. We don't have the bank runs we obviously had then, but we are seeing a lot of the same things play out. History does repeat, not always the same. But I think when you look at those factors, it's very obvious that we're probably not at a market bottom, and we're still continuing to see things deteriorate.
So over the near term, what do you expect to happen?
I still stick to what I said previously, that I do think we could potentially hit Dow 6,300. Again, I hope I'm wrong, but that would bring us down to close to single digits on the terms of PEs for Dow stocks.
Kevin, sentiment is sour. There is just no other word used you can use to describe it. So. Right. Are stocks cheap enough? I mean, he's already talking about oversold.
I think the market has to get cheaper. Last year was a terrible year. The market has gotten battered and bruised. This year was one of the worst starts we have ever seen. And everybody, I think, was hoping that the lows had been put in. That is what everybody had been saying on TV. That's what everybody had been believing. But clearly, those weren't the lows, or at least it doesn't seem so, because if they were the lows, how can we keep making new lows?
Right.
So I think what people need to see is there has to be some kind of catalyst. Either the market has to make a significant and meaningful rally from these lows, distance itself from where we are by 20% or more, and then people will feel like they're missing out, or the market is going to have to make a new low, a significant new low, kind of like what we talked about a couple of weeks ago, like 1938, where we saw the market base, and then all of a sudden it collapsed another 20%. Once we saw that, though, the market made a beeline up, and I think we were up like 50 or 60% from that point. But I think what's happening is that people are more afraid of the risk than they are of missing out, and people are unwilling to stick their toe in the water at this point. So I think valuations have to come down, prices have to get cheaper, people have to believe finally we have hit this low, and I think in tandem we need to see some real economic activity take place, because this economic activity was first forecast to begin in the second part of 2008. Then it was moved to the first part of '09. Right. Then we moved it back to the last part of '09. Now we're all the way into the beginning of 2010. So this thing keeps moving into the future. So people are unsure as to what's going on. They need to see something happen.
Let me add something here. Most of the time, the market will start turning up before there's any clear signal.
Correct.
Okay, it is just a sense that it's been long enough that here the prices have come down low enough that seasoned investors are willing, that the odds of success are good enough that they're putting their money in. Right. There's not enough selling pressure, and the market resurrects before there is any economic activity that will be where unemployment keeps going down well past where the market starts to rebound. And so don't look for that clear signpost in your yard. Right. Okay, that yes, now the water is safe. Yes, we as a group. Surprisingly, are in general agreement here that we have not yet seen the bottom, but that doesn't mean that there's not opportunities, there's not ways to make money, but we're probably 20-ish% away from a real market bottom at this point.
All right, I did not open the mayonnaise jar this week to find out, the numbers, or refresh my memory on the numbers as far as your market targets were concerned for year end. But what does this do to alter those targets long term here? Anything?
I think really it doesn't. I've said before I predicted a bigger bottom. And it's interesting. If you look at earnings estimates, we're continuing to see them cut across the board. And it's pretty interesting because I went back and looked 2 years ago at what people were expecting for full year 2007 earnings at the same point. And if we look at what they were expecting then versus what we're expecting now, we see a 70% increase in the number of negative revisions. So relative to 2 years, people are considerably more bearish now than they were 2 years ago. Mm-hmm. And that's not surprising. We're in a recession. And when you're in a recession, we're seeing worldwide economic problems. I do think the government's contributing to the issues. When you're looking at Citigroup, you're looking at Bank of America, we have this, will they be nationalized, will they not?
That's a big fear all of a sudden.
It is a big fear, and I think, the government's trying to make some bold steps. I know Obama's trying to be careful, too, and not make too many missteps. But I think at this point, some really big, drastic action, just so people know, okay, this is what the government's going to do, whether we like it or not. And we can see some of that with the housing bill. Rick Santelli might want to rant, but I think what the markets need now is some time from the government. This is our plan. It's going to be big. It's going to be dramatic. We're going to do this. Add some certainty because, as Steve said, we're not going to see things turn around economically or even in terms of earnings estimate revisions before prices go up. But as long as we have this uncertainty, we don't know when the rebound's going to occur. As Kevin just said, it keeps getting pushed out. We don't know what the government's going to do. We don't know how much more money these banks are going to lose. Once we get a sense that all that's being somewhat contained, then the market might be able to start the process of truly bottoming, and we start seeing a rebound in stock prices.
Yeah, I've heard that twice now. Something significant, a significant event will bring people back to the stock market. Mm-hmm. The only thing is we can't tell what that significant event might be because there are too many wild cards out there.
Steve said it. He said that the market usually starts to recover 6 months before the economy recovers, and I agree with that. The problem is that if we really were going to recover in the second part of '09, we should be seeing a stock market recovery now. Since the economic recovery keeps getting put into the future, the stock market recovery keeps seemingly getting put off into the future as well. I don't think we need to see the economy fully recover. I think we just need to see a slowing of the acceleration on the downside stop. In other words, we need to see job losses not accelerate so much, slow down a little bit. See manufacturing, the slowdown that we have seen, see it decelerate a bit, and start to see a little bit of this economic stimulus finally take place, because in order to sell this stimulus, they had really talked the economy doom and gloom. I mean, people are waiting for capitalism to collapse. Mm-hmm. So, but as far as what it does to my target, I'm still thinking that if we go down to, let's say, the 6,000 handle, 62, 63, somewhere in that area, I do believe that at that point you're going to see everybody rush into the market to snap up these bargains, and then I believe this hopefulness will return, and then we start making our way back into the 9,000 or 10,000 handle.
Yeah, that number 11,000 kept ringing in the back.
Yeah, which I have reduced it. Which I think is a bit aggressive at this point. My prediction was the market was going to end up 1 point higher than where it started, which is 87.76 or something like that. And that was, but as we said, it was going to be like a roller coaster ride or a heartbeat, or I think you said Charlie Brown's sweater, the pattern.
Right, the pattern,
yeah. And so far we're getting that leg down. Okay, we were getting that leg down, and there will be a couple ripples in between. I don't believe the final capitulation is until the second half of this year. I don't think there's much that's changing my opinion of that because I don't believe there's an economic recovery until 2010. So you take a look back 6 months from there. So therefore, October-ish would not be crazy to start seeing that market bottom. I think it will be around 6,000, the market bottom. And yeah, I think we could see easily a 50% rebound from that point, maybe even a notch better, to get to 10,000 a year from then. And you don't want to be out on that rally. So here again, a long-term investor, if you're saying to yourself, and by the way, this is like, I got my trading account and I got like my 401k. My 401k, I'm not playing around. This is close enough to bottom. I'm still in my 401k. I'm adding money to it because I'm not trying to time out my 401k. My trading account, yeah, I'm still playing the way down because that one is where I can be more active. Okay, don't try and time out. Is it going to be exactly in October of this year? I don't know. I put out my prognostications, but I'm not even willing to stick by that for the 401k, for my kids' college funds, and this money I don't have to touch for 20, 30 years.
Well, market timing's always been a fool's game.
Except for call me a fool?
I mean, trying to call those exact points.
Right, it's very difficult. Right, so we're just playing the odds. The odds are most likely the market will head a shade lower. And we have three people here who have very different ways of going about how they invest who are coming to that conclusion. But ask them how short they are or how long they are, depending on the account. I think you'll find that most folks, even if they think it's short-term negative, how much more negative is it from here, and what are they doing with their long-term money? I think you'll find that most are in the long-term money. In short-term money, they're defensive or going short.
Right. Okay, well, there you have it, the continuing saga of what is going on with this stock market. With everybody here at the Roundtable, I'm Terry Ruffalo.